Have you ever wondered why some investors seem to buy stocks that nobody else wants, and yet years later, they're the ones walking away with the biggest returns? That's the power of value investing, and today, I'm going to break down exactly how it works, why it matters, and how you can start applying it in your own financial journey. Value investing is all about one simple idea. The market price of a stock is not always equal to its true worth. Price is what you pay. Value is what you get. Legendary investors like Benjamin Graham and Warren Buffett built fortunes by buying companies when the price was lower than their intrinsic value. They understood that markets overreact. Sometimes stocks are overpriced, but sometimes they're overlooked bargains. So how do you spot value? Let's start with the basics. Every business has an intrinsic value, which is the present value of the cash it can generate over time. One way to estimate this is with a discounted cash flow analysis, projecting earnings into the future and then discounting them back to today. Another way is to use valuation ratios, like price to earnings, price to book, or price to sales, and compare them with industry averages. None of these are perfect on their own, but together they can tell you if a stock is cheap or expensive. Now, a key principle of value investing is the margin of safety. Think of it as your cushion against mistakes. If your estimate of a company's value is, say, $100 per share, you don't buy it at 99. You wait until it's 60 or 70. That way, even if your assumptions are off, you still have room for error. That margin of safety is what protects value investors from overconfidence. But value investing isn't just about numbers, it's also about quality. A company can look cheap, but still be a bad investment if it's drowning in debt, losing market share, or cooking the books. True value investors focus on businesses with durable competitive advantages, things like strong brands, cost advantages, or loyal customers that competitors can't easily steal. Buffett calls this an economic moat, and without it, low prices can quickly turn into value traps. Let me give you a simple example. Imagine a beverage company that earns steady profits year after year, sells a product people buy no matter the economy, and has a trusted brand. If the stock market suddenly pushes its share price down because of short-term fear, a value investor sees an opportunity. They estimate its fair value, compare it to the market price, and if the price is well below fair value with a margin of safety, they buy. Then they wait patiently for the market to catch up. And patience is critical. Value investing isn't about quick wins. It often means holding investments for years while everyone else chases the latest trend. That's why discipline is the real edge. Most investors can't wait long enough. They get distracted, emotional, or impatient. Value investors stay grounded in their research and their process. Now, if you want to practice this hands-on, I've created 2 digital products that can really help. One is a stock valuation spreadsheet designed to make intrinsic value calculations easier, and the other is a real estate valuation tool that walks you through net operating income, capitalization rates, and internal rate of return. You'll find the links in the description below if you'd like to check them out. So, what can you do this week to practice value investing? Start simple. Make a watch list of companies you understand. Read their annual reports, yes, the boring stuff, and focus on earnings, debt, and competitive advantages. Play around with basic valuation tools like PE ratios, or even a simple discounted cash flow calculator. And most importantly, write down your reasoning. Treat every investment decision like a business decision. Before we wrap up, let's be clear. Value investing isn't a guarantee, and this video is for educational purposes only. It's not personal financial advice. But if you build the habit of looking past market noise and focusing on intrinsic value, you'll already be ahead of most investors. If you found this video useful, make sure to hit that like button, subscribe to ClearBooks Academy, and turn on notifications so you never miss our next lesson in finance and investing. And let me know in the comments, which company do you think is undervalued today? I'd love to hear your thoughts. Thanks for watching, and remember, price is what you pay, value is what you get.